thanks for coming. I'm really keen to talk to you about implemented portfolios and how we work with Wealth Depot to manage your investments. Now, just with some of these chats we've just had, I've realised that there's some people who are long-standing clients of Sebastian's and you're very familiar with what we do. And then there's some people who are quite new to implement portfolios, the IMA service and what we do. So I'm going to try and cover a range of different levels of understanding here. So bear with me, but please just ask questions as I go through. Okay, I want to make sure this is clear to everyone. Now, firstly, how is this volume? Is this okay for everyone? Everyone can hear me? Okay. Now, I plan to talk for about 25, 30 minutes and then have time at the end for questions. But if you have anything you'd like to ask as I'm speaking, just raise your hand and ask. And either I'll answer on the spot or I might say, okay, I'm going to come to that and I can do it justice in a few minutes. So either way, it's really important for me to make sure that I'm telling you the things that you want to hear. Okay, that will help me sort of steer in the right direction. Now, I thought I'd start just by giving you a very brief introduction to Implemented Portfolios, the company I work for. So who is IPL? I'll call them IPL. We are a value-oriented investment management firm. And we've been around a while. We were founded in 2010. So there's quite a bit of experience, not just in terms of the people who work with me having long experience in the investment markets, but also in doing what we do specifically at IPL. The IPL process itself has 15 years of history. Okay, so we've got a pretty decent track record of doing this. We know what works. Another thing to be clear on is that we are fully focused on a particular investment structure, which is a managed discretionary account or IMA. You can call it two different things, but it basically boils down to the same thing, which is that an individual client account can be customized and tailored to your specific needs. Okay, that's really a very special structure. At the end, I'll come back to why that's a really good structure and why we think it's the best one. Okay, but I won't go into the detail yet. IPL is part of the Lonsec and Evidentia group. We started off in 2010 as an independent boutique, quite a thin operation, just a few people, and the operation has grown in that time. Now we're part of a larger group. The only thing you really need to know about that change is that it's all positive from the IPL point of view, because it means we can do what we've always done, but do it better. We have more resources, more people, more experience, more capability, and more funding for infrastructure, technology, and so on. So our approach hasn't changed, but we do it actually more effectively because we're part of a bigger company. And IPL partners with advice firms like Wealth Depot to deliver a tailored portfolio investment service. And it's a really important partnership. We have to collaborate with Sebastian and his team to make sure that your individual accounts get the specific treatment that they need for your needs. So we're sort of, there's some complementary expertise we bring. IPL has a lot of experience in managing investments, and Sebastian and his team, they know your specific needs. They can help you with your planning, your goal setting, savings, budgeting, and working out where the best investment allocations will be, what style of investment allocation is best for you. And together, we can tailor a portfolio to your needs. Okay, so there's a degree of co-piloting, you could say, that we actually have to work together to decide what's best for each individual account. And I'll come back to that at the end because I'll talk about this IMA or MDA structure and how we can collaborate there to give you the best results. How's that so far? Is that clear enough on what IPL is? Now I can just sort of go into the main flow. This is what I plan to talk about. Firstly, just to give you an update on the financial markets and the economic outlook. There is a lot happening. There's a lot of questions about where the financial markets are going, what's going on in the economy, so I can talk about. Then I'll go through some of the nuts and bolts of how we actually invest. So that's the process of how IPL does what it does to manage your portfolio. And then I can talk about some recent changes in the portfolio. We've actually just done some trades last night, so there's some pretty fresh news that I can give you and explain why we're making these changes, but also talk about what's happening in the near future. we can sort of look ahead and say, okay, these are the things we're looking at, we're considering for the near future. So this is what might happen soon. And then I'll come back to talking about the MDA service, how these particular structures are really very helpful for managing your investments. Please just ask me if you have any specific questions or if you want me to drill down into more detail at any point, just say so. Okay, let's talk about the markets. I think the best way to summarize this just with one chart. Some of us really like communicating through charts. I'm one of those people. So this is a whole lot of major share market indices, all on one chart, all rebased so you can see them all together. And this is only going back just 12 months. So you can see some pretty big swings in those share market moves in just 12 months. Now, if we cut that down to just talk about the calendar year to date, 2025 to date, we can divide it into two halves almost. First half, we get panic. Now, this is, unfortunately, a lot of this has to do with Donald Trump. I wish it weren't so simple, but actually a lot of this sort of sentiment change, which is driving the short-term financial market movements, is Donald Trump. So he comes into office in January, talks a big talk, scares a lot of people because he's making these really bold statements about what he's going to do with tariffs, especially with China, but the rest of the world. He's going to pursue policies which he thinks favor the USA, but might be hard for everyone else. This all comes to a head in early April with the announcement of these reciprocal tariffs that he's planning to impose. And there's a lot of panic, a lot of fear in the markets. Then in the second half of the year to date, we get this huge relief rally. So there's this huge recovery when those tariffs end up being deferred for 90 days. And then there's several other major backflips, backsteps, flip-flops from Trump. He's made these very bold, aggressive statements, and then he backs down at the last minute. So there's a concept of taco, Trump always chickens out, which is taken as a good thing because it means basically he's a lot of talk, but in terms of actual impact, it's not as bad as everyone thinks at first. Now, I would say at IPL, we're very conscious that sentiment can drive financial markets in the short term, but we are value-driven investors. We try to look through those emotional factors. You can see a lot of sentiment swinging back and forth here, and I think in both cases they were overdone. So in the first half, there was probably too much fear and too much pessimism. And now you get almost euphoric optimism. This is sort of going too far the other way, I believe. Well, that's what some of our valuation metrics are showing. But let me talk through the economic backdrop, and you can decide if that sounds right to you. Actually, I should just remark, right at the end, you can see a few big step ups as we start to get specific positive news about tariff deals. So the original threat in the early April was there were going to be these very large tariffs. That's basically a tax or a levy on trade, which was going to really damage global trade and which would slow down the global economy. All right. And now the news we're getting is that most of the major trading partners have now done a deal with the USA, which reduces the tariff rate. Doesn't get rid of it. It's just not as bad as was initially feared in April. Okay, so if you look at that green, look at the green line there, which is Japan, you can see it almost just goes vertical straight up because they managed to do a trade deal where the tariff that we threatened was 25% and they knocked it down to 15%. And that's taken us such good news that share market just rockets up like that. So you can see what I mean by euphoric relief. It's good news, but it's not net positive. It's just not as bad as everyone feared. Yes.
But the country that's missing there, China.
Yes, China is not represented there. China, the share market has actually done well. I just didn't want to have too many lines on the chart, but China is yet to do a deal with the USA. So there is still a lingering concern there. But I have to say the noises that we're hearing are sounding more positive. So the initial fear at the start of the year was actually that Trump would be really hard on China. He certainly had a very, very aggressive rhetoric against China. But then there were negotiations which basically passed, didn't really agree too much except to kick the can further down the road. And so do you remember when the tariffs being threatened between the US and China were just getting silly? They were over 100%. So that was put off, delayed, deferred. So basically, the two sides could talk. They could have a negotiation without blowing anything up. That was positive news. And then now they're having further negotiations, which seem to be going fairly well. Okay, so look, it's quite possible that things will just get deferred for longer, kicking the can further down the road. Okay, but that in itself is a positive. At least it's not blowing up. At least you don't have the US and Europe, or US and Japan, or US and China lobbing bombs at each other in a tariff sense, just on a downward spiral. So that's still taken as a positive. Let's just look at the economic backdrop. There's a lot of data points you can use to gauge the economic status, but I've just picked out a few here for the USA. And the point I want to make actually is that things are tracking along quite well, surprisingly well, for all the fear that's in the share, that has been in the share market about what Trump's policies could do to the economy. Now, of course, this is historic data. So it is in the past. It is still unclear what's going to happen in 6, 12, 18 months' time. But so far, things are looking okay. Now, you might be looking at the green line. I can understand you look at that green line, GDP growth, and say, well, that's not good. That's a negative GDP growth. But that's a special case. That is the March quarter GDP growth, and it was skewed down by a lot of preemptive buying of imports. So you can imagine, here's Trump threatening he's going to put a big levy on imports into the USA. So US manufacturers and US retailers go out and buy up big before April, because they want to get in before the tariffs come into effect. Okay, and that skews GDP down. And then you've got an extra effect from an extreme winter and the California wildfire. Okay, so that's a bit of a distraction really on the GDP front. The blue lines are unemployment figures. You can see they are going up ever so slightly. So yeah, the job market is getting ever so slightly worse, but compare to when we were coming out of COVID, and you can see how those lines look in a more extreme scenario. Okay, so in a relative sense, recently, things are pretty good. The US economy is looking pretty good in terms of the historic data. And with these recent trade deals being announced, things are looking more positive for the near term also. Here's another set of metrics for the US. And you've got purchasing manager indices, PMIs, which basically summarize economic activity. If they're above 50, it shows economic expansion, and if they're below 50, it shows contraction. The pink one with services, that's been above 50 for some time, dipped below into contraction briefly, and just recently the latest number, which is not on this chart, has shot up. So things are okay in the service sector in the US. Manufacturing has been in contraction for some time. That's nothing new. It's still just lingering in slightly contraction territory. But hey, it might get a boost if Trump is successful in bringing more manufacturing onshore. There might actually be a boost there from his tariff policy. One to just note, though, is that the GDP growth or the economic growth in the US is getting more dependent on government spending, and employment especially is getting more dependent on government employment. So here you can see just private sector employment, private sector hiring actually went negative most recently. So there is a little bit of a slowdown in the private sector there, okay, but it's no cause for panic. Let's consider some similar metrics for Australia. And generally the story here is maybe a little bit more mildly negative. Our economy is slowing slowly. Okay, so there's no cause for alarm. The RBA is not panicking. The commentary from them says, yeah, we're actually pretty happy. We're just watching. We're more concerned with inflation. So that's good news. They're not panicking about economic growth. They specifically said, you can see this blue line is unemployment stepping up. It's a blip. It's really nothing to be concerned about. Okay, it's very minor compared to even if you look back at COVID, the COVID period here, that's what major unemployment looks like. This is nothing. Okay, so actually our job market is still very tight. People still have jobs. People still have money to spend. So our economy is okay. Inflation's coming down. That's a good thing from the RBA's perspective. And sorry, just one more thing. The GDP growth is holding up okay, but it's very much supported by government spending. Almost 30% of our GDP is now government. So that's something just to keep in mind, some cause for wariness. These are investors' expectations for the RBA cash rate. And all we can see here is that expectations have gone from a very, very gradual decline in the interest rate back in December to a slightly faster decline in July. Not a major change. It just shows really that inflation's under control. That's a good thing for the RBA. But we're not seeing a really sharp drop off, which would indicate someone panicking. If the RBA drops interest rates 50 basis points or more, that shows they see a major problem. So it would be a red flag to the markets. We're not seeing that. Everything's okay. So in summary, the economic backdrop is actually pretty good overall. Okay, not amazing, but it's pretty solid, especially offshore. The US economy is chugging along very well. The tariff news is looking good, especially these last 2 weeks, because we've got major deals being done with, or the UK was first cab off the rank, but then Japan and then Europe. We still need to get China, but the other markets are all sorted, and a few other minor trading partners have also done trading deals. So generally it shows Trump's ready to do a deal. He's ready to negotiate, to compromise a bit, and other markets are as well. They don't want a war, a trade war. Okay, so that's good news. And here's a lot of talk, basically. There's a lot of bark, a lot of noise, but actually in terms of real impact, so far, we're not seeing anything like that. Doesn't mean there can't be something further down the track, but so far, he backed off from a lot of the most aggressive statements. And it kind of indicates, I think the markets, the investors are getting a bit more confidence that there are some adults in the room. There are some people who are actually a bit more responsible. Trump might put some really crazy statements on his social media, but then there's people like Scott Bessent, the Treasury Secretary, and JD Vance, who has quite good economic credibility, who are actually able to be a bit more responsible. But if you think back to that first chart I showed you of the share markets, everything is very highly priced. So it's priced for a lot of things to go right. Okay, there's an assumption built into those share prices that everything is going to go well from here. And I think that might be a little bit too much optimism. Now I want to talk about how we invest, but let me just check in. Is that making sense? Does that make things fairly clear in terms of the backdrop? Okay. So in terms of the process we use, we're value-driven investors. So we're really focused on fundamental value. So when we say we invest based on fundamentals, that means the concrete things that you can actually measure. We try and look through emotional factors, sentiment in the markets, and look at concrete things like price, company earnings, dividend yields, interest rates, those things that you can track. Okay. And we think long-term returns are based on those fundamentals. So the swings you saw in that first share market chart, that's short-term, that's sentiment-driven. Long-term, it comes back to earnings, dividends, interest rates. And we think value-based investment is the best way to get long-term returns. Okay, so I'll show you how that actually works in practice in a minute. And because we're very focused on value, we want to buy the cheapest or best value investments and stay away from the ones that look most expensive and most inflated. Okay, you can get some situations where markets go into a bubble territory where the pricing is not based on what's happening underneath. The price of the shares is not based on what the companies are earning now. The price of the shares becomes based on what people think those shares will trade at tomorrow. Okay, so it becomes removed from the fundamentals. Okay, and then you get sentiment factors like FOMO, fear of missing out. People buying today because their friend bought yesterday and he's made money, so now I'm going to buy in and make money. And that can be self-perpetuating in the short term. People buy because they think share market's going up, so the share market goes up because people are buying, and it goes on until it doesn't. But we try to stay away from those sort of bubble situations. Okay. Yes.
With the shares that you select, how do you make a differentiation between, say, growth assets, growth stocks, where probably don't have a lot of yield, let's say, and those ones where you obviously paying income, so the yield less capital growth ones? Like, how do you come up with those?
We are aware of the different attributes, but I would say our main portfolios are focused on indices. So it's not one specific share that we're picking. it'll be a bundle of shares in the index, but still that can have those different attributes. So for example, we've had previously large allocations to Australian financials. Australian financials are mostly banks. Banks are more value oriented with higher dividends yield. Okay. So we're conscious of the value bias in a bank allocation. But just because we're value oriented investors doesn't mean we can't hold growth shares or an index that has a growth exposure. It just means we have to get it at the right price. Okay.
Then the only way that you can really provide an income to, say, clients that are in, say, retirement, they need the income to be selling those growth shares down.
Well, that is one way, but because we're managing multi-asset class portfolios, it's not just shares. There's also property, infrastructure, bonds, and other fixed income investments. So there's a range of investments, and especially the fixed income investments, they have a high yield. Okay, so there's always sources of income. So we're not under pressure. In fact, that's one thing that's important about our strategy. We try not to be in a situation where we're under pressure to hold any particular asset. Okay, we can get income from many different places.
But I forgot to ask that question, is that when it's a really, it's not a good time to sell and the portfolio needs money, yield, pensions and stuff, how do we do that without having to sell a share at a bad value? So
Right.
You're saying is that you have a mix, say, not under pressure to sell any time, enough income to pay.
Correct.
This to tend to yield out.
Yes. That is actually a really important point. And there's two levels at least that I can talk to it. One is, as you say, we have sources of income coming into the portfolio always, but there's also a level of doing the trading for the portfolio to build up cash. I think I can do it better justice if I talk about that at the end, talking about the MTA structure, because then I can show you why this structure is actually really helpful for those purposes, for that kind of client who needs regular income. Okay, so we believe in long-term returns driven by fundamentals, and we try to avoid the overinflated markets. So how does that work actually in practice? Well, we try and calculate an expected return over a 10-year time frame. That's pretty long term. We estimate what sort of return we can get from this different asset classes. So that's different equities markets, Aussie shares, US shares, Japanese shares, European shares, different industry sectors. And then based on those estimates, we can rank them and work out where are the best returns coming from. Now, this comes back to value, because the best value markets are generally going to be the ones offering the highest prospective returns, and vice versa. The most expensive markets will offer lower prospective returns. Generally, I'll show you how we build up those return expectations. But we rank those expected returns for different markets, and then we allocate more of the portfolio to the best value, highest returning sectors. And then we still want to maintain quite a bit of diversification in the portfolio, but generally there'll be a strong tilt towards wherever we see the best returns, okay, towards the best value markets, and we'll avoid those which seem too expensive, okay? And comparing us to, say, an industry fund, where there's a lot of what we would call benchmark hugging, where they're very conscious of a market index, and they pretty much match that market index. They might hold a tiny little bit more of something or a tiny little bit less. IPL has quite a lot of flexibility to allocate your money to where we see the best opportunities. All right. And so if we think a certain segment of the market is really expensive, we just don't need to own it at all. Okay. So again, we don't feel that pressure to be there just because everyone else is. We want to put the money to work in the best places. Okay. Now, the way we trade is we stagger portfolio changes over time. So we know we don't have a crystal ball. Okay. Some people in my job, they'll tell you, they'll try and make out that they can predict the future. I know I can't. Right? So we focus on the value we can see. But even then, if we think a certain market is really expensive, it can get more expensive in the short term. Okay, because there can be momentum. So it can go higher and higher. So we don't want to sell everything right now. We'll sell some if we think it's expensive. And if it keeps going up, we'll sell some more. And I'll show you later on. I've got some charts that I can illustrate how we've actually done that in practice. Likewise, we might think something's really cheap. We want to buy it. But we don't want to use all our portfolio firepower and buy everything at today's price, because cheap things can get cheaper. Okay, so we'll stagger those trades over 3 months or 6 months to make sure we can get a fair price across the portfolio. How's that so far? Is that making sense?
Yep.
Okay. Okay. All right. So how do we do this return forecasting? We want to make sure we can get just told you I can't predict the future, and here I am talking about a return forecasting. Okay, that's kind of brave, isn't it? Let's just be clear. This is our best estimate for future returns, and we know it won't be exactly perfect. There's always going to be an error band around it. But I'll show you how we build it up from concrete measures, from fundamentals. Okay, we start with income. This is a real thing. Dividends that have been paid. Let's talk about shares. It's easy to talk about share markets. So we're using the example of Australian mid-cap shares. So we start with the dividends that were actually paid on the Aussie mid-caps most recently, including the franking credits. Franking credits, we always think in after-tax terms. Okay, so this is an actual number that's measurable. Okay, that's concrete. And then we think, well, that was past dividends. We want to think about future dividends. Okay.
That one's funny.
I saw it again.
So we have past income. We want to go to future income because we want to think, what can you earn in the future from these shares? Okay. So past dividends were paid out of past earnings. If we think what a future dividend is going to be paid out of future earnings, so how are earnings going to change? So if we make our best estimate for how earnings for companies are going to change in the next 10 years. And we can base that on how profitability is going for these companies. Now, let me take a specific example, okay? So take the Aussie resources sector. The Aussie resources sector has gone through cycles of profitability. There were periods, you might remember, before the global financial crisis, and then straight after COVID, when Aussie resources was booming. They were making tons of money. China was buying a lot of iron ore, paying high prices to run their steel mills full tilt. And so Aussie resources companies were making really high profits. Then there are other times where they have lulls in profitability. Really, they're under earning, okay, when there's not enough demand, too much supply. So there's cycles, right? High profitability, low profitability. We take a long-term view and assume over 10 years, that profitability is going to revert towards a long-term average. Okay, so we look at an industry and we say, okay, they're over-earning at the moment. We'll assume over 10 years, probably reverting to the mean profitability. So earnings are probably going to slow down. Okay. And then we think about economic growth. There's some other factors that drive general earnings growth. Okay, so we make our best estimate for where the company earnings are going to go. And then we have to think, well, we know this is our best estimate for future earnings. What is an investor going to pay? What's the price that people will pay for those future earnings? So you're familiar with PE ratios, price to earnings ratios. So that's the price that an investor will pay for a certain set of earnings. And that also goes in cycles. Sometimes when investors are really euphoric, like now, they'll pay really high multiples, 20 times, 25 times the earnings. Okay, and then other times when investors are really fearful, pessimistic, then they don't want to pay a high price for those earnings. They'll pay 10 times or 15 times, right? And again, over the long term, these things tend to wash out. So we assume reversion to the long-term average, unless there's a really good reason for something to change. So right now, Aussie mid-cap shares are trading on about 28 times earnings, which is massive. Okay, if you compare the history, that's just very, very high. Partly it's due to some of these, say, mid-cap resources companies that have been over-earning for a while. Okay, so we assume that reverts down to a long-term average around 19 times. Okay, and based on this, we can get our best estimate of forecast return. So that's Aussie mid-cap shares. That's one segment of the market. We do that over and over again. I won't take you through it every time, I promise. But that gives you an idea of the process we go through to forecast the returns for one particular market segment. We do that many, many times, and we rank all of those returns, work out which are the best return. I can tell you 4.7% really isn't that exciting because this is an equities, this is a shares index return. And shares always have risk. You compare that to a 10-year government bond yield, which pretty much has no risk, unless you think the Aussie federal government is going to default on its debt, which is highly unlikely. Government bond yield is pretty much risk-free, and you can get that to pay 4.3 or 4.4%. So if you're going to take extra risk in the share markets and only get 4.7%, that's not a great return. That would rate as expensive in our terms, right? Because the return on offer is not very good. So we can then rank all of those different markets against each other and just say, where is the best value? And here in Aussie shares, you can see 4.7% shows up as pretty fully priced, not very attractive. Now I can compare that to some other markets. So this is the tipping points sheet that we send out every month. It just summarizes where we see the best value. Aussie shares, not great value right now. Resources look okay. Resources specifically, they look much better value. But overall, Aussie shares not good. Global shares are a bit of a mixed bag. You've got US shares way up here. They're looking more fully priced. But there's some better value opportunities here. Japan, US small cap shares are actually much better value. So these are not your magnificent 7 stocks. These are the names, company names you probably don't know, but they're still solid companies in the US, and they have better prospects because they're looking cheaper. And then you've got emerging markets, including China. They're more risky, but they're still better value. Okay, so our portfolio is concentrated where we see better value here. This sort of fair value. That's the tilt that we put into the portfolio. And then over in the property segment, we're focused on these fair value areas which are global. So global infrastructure and global property trusts. That's where the portfolio is allocated now because we see better value there. How are we going so far? Is that making sense? Yeah. Happy to take any questions? These are our standard portfolios, ranked from defensive through to high growth. And you can see with the different colors, we've got different asset class allocations there. So basically, defensive has much less global and Aussie equities, and much more fixed income, bonds, cash, and high yield. And incidentally, these also have much more yield from those assets as well. More fixed income, more cash means higher yield. So more income for those particular clients who need it. Right up here, much more growth and more risk from the higher shares allocation. So let me just show you, just take one example of our balanced portfolio, the number 3 portfolio, and show you how that's been managed over time. So this just shows you how we allocate money over time. Using that example, that's the standard, what you can see there, that's like the long-term target rate. And this is how it's changed all the way back to 2011. Okay, so just look recently, what's been changing in our portfolio. You can see global shares in orange. We're investing more in those, and they've also been going up, so that makes a difference too. So their proportion of the portfolio is growing over time. Aussie shares in red, shrinking. So they've been going up too, but we've been selling as they go up. So because we think Aussie shares are looking overpriced, we've been trimming those allocations to the portfolio and putting the money elsewhere. Property pretty much holding steady in purple, but you can see that light blue allocation, high yield, that's where some of the extra money is going. So we're trimming Aussie shares and trimming some of these other shares that are going up and looking too expensive, putting money into high yield debt. That's an alternative risky allocation, but it has better returns from what we're seeing. And then bonds pretty much tracking along, and cash is building up. As we sell some of these shares that are looking expensive, we're holding a bit more cash on the sidelines. So we're ready for a big sell-off. If it happens, we don't have the crystal ball, we can't tell. But if it happens, we'll have some spare cash to put back into the market. Let me just show you how that works in practice with the Aussie share market. So this is the performance of the Aussie share market for going back to 2022. And this just shows you how we've allocated over time. So we actually really liked Aussie shares for a long time. We've had an overweight position in Aussie shares because they represent really good value, especially the banks. Banks had these very high dividend yields they're paying with the franking credits are very attractive. And the Aussie share market went up and up and up and up and up. And then in about mid-2024, by that point, it was looking pretty expensive. The banks had what we call re-rated. The price paid for their earnings had gone up quite a lot. And so we got to the point where we thought, yeah, this doesn't look good value anymore. So we're going to trim. So we, whoa, sorry, everything went out. Okay. Like that. That's good. All right. So we started selling some of that exposure to get to a neutral position. That was just in time for the big sell-off that happened in August. Does anyone remember that one? It seems it's a faint memory now, but in August last year, there was a really big sell-off, big panic about Japan, and then big market fall, but then we recovered amazingly quickly, and soon the share price were very high again. So we got to the point where at IPL, we were thinking, okay, this is just looking too expensive. Everything priced as if everything's perfect in the economy. It really isn't. So we started trimming, and we did a staggered sale. So over 4 or 5 months, we were trimming small portions of the portfolio to the point where we're quite significantly underweight. So this, from that previous chart I showed you, this is that red section of Aussie shares shrinking as we sell more and more, as the share market goes up, which means that we were very well positioned when there was this big sell-off in March and April. Okay, we didn't predict that would happen in March and April, but we were ready. We'd sold because everything was looking expensive, and then suddenly it got cheaper, so we could buy more at that point. So when the share markets really sold off in April, we were ready. We had spare cash, and we could put some more money back in, specifically into resources. So the Aussie mining sector had really sold off before that because of all the fears about China. You know, Trump talking a really aggressive talk about China, how he's going to slap big tariffs on them, slow down their economy, stop them buying the iron ore from Australia. And so we could actually buy into resources and put more of a tilt on our Australian shares exposure there. But we had a really sharp recovery from then. So there's still this real euphoric optimism in the share markets now, to the point where it's time to sell again. We don't plan to buy and sell so quickly like this, but the share market swings at the moment, they justify it. Okay, so we are valuation driven. So we'll sell if things get so expensive like that, which is what we did. So that brings you up to date on where the portfolios are at now. Okay, it gives you a sense of why we are so underweight Aussie shares. All right, now coming back to this, I just wanted to show you now, same table, but where we are positioned in the portfolio. So Aussie shares fully priced, and so we are very underweight. Global shares is a mixed bag. So we actually are overweight, but it's very targeted to these bluer arrows. Okay, US small caps, Japan, bit of Europe and UK at the bottom end of fully priced, and Asia ex Japan. And then in property, we're focused on these blue segments too, and we've got a small overweight to those. Okay, and they have some attractive yield. Infrastructure is done particularly well for us, and we think global REITs is just looking good value, so that's got some better potential future performance. Okay, now in terms of once we know where we want to put the money, what sort of asset we want to put it into, how do we choose which building block to use? Because there's a lot to choose from. So all the pieces of the portfolios that we manage are listed building blocks. So generally exchange traded funds. Okay. So the sort of things we think about are, well, does it suit our needs? Is it the right exposure for us? Yes. Does it come from a provider that's credible? You might know some of the names like Vanguard, iShares, BetaShares, VanEck. These are the names you'll see in our portfolio. Okay. We know these operators. We know they're robust. Okay. We're not going to put money into some fly-by-night operation, which is not well known or is not a solid provider of these sort of ETFs. So all of the ETFs that we hold in the portfolio are offered by these large institutions, very credible operators. Okay. But we still keep the ties on the individual product to make sure it's properly suited to our needs. We test the fees. We're value investors at every level. Okay. We don't want to be paying very high fees for one of these building blocks when we can get an alternative much cheaper. Okay. So we'll sort of scour the market and look at all the different options. And we have a benefit of being able to look offshore as well. A lot of managed products which invest in ETFs can only own those listed on the ASX. And that's a limited pool. IPL can invest globally. So we can own shares listed in the US. Now you might know if there's a small pool of companies or operators, that means less competition. You might think Australian major banks, less competition, more profitability. They can sort of gouge pricing. That's what happens in Australian ETFs. If you can look offshore, you can get the same ETF exposure for half or a quarter of the management fee. Okay, so that's a saving that comes back to the client accounts. Okay, it adds up. that is actually worth paying attention to over time. And then we make sure that there's enough liquidity, because we know clients will, at some point, they will want to take their money out. They don't want to wait for 3 months or 6 months having their money locked up. So all of the building blocks now in our portfolio are liquid, they are traded daily, and they can be sold immediately if needs be. Okay, so that's important, that you can get the cash if you need it in a hurry. All right. We've had some cases during COVID, during the financial crisis, where people find that a property investment that they made, a property trust or something they put money into, that cash is actually locked up and they can't get out when they need it. That doesn't happen with IPL. We have the liquidity ready. Okay. Now I can talk about changes to the portfolio, but I'm also happy to change course. If there's anything you'd rather know about, or if you'd like to hear more about what's happening in the financial markets in more detail, or just ask me questions about what's going to happen with tariffs or Trump or crypto or anything like that, feel free to throw those questions in. Yes.
I am interested in crypto. I wasn't too sure if I should ask. Because I mean, that's like up and down, like
Yes.
at the moment it's on up significant. Is there any way that you're talking about you've got measures in place, you can measure indexes and stuff like that with crypto? Is there anything that IPL or your partners may have that sort of can predict?
No, is the short answer. It's a really tricky one, but it comes back to what I said at the start about an investment on fundamentals. There are no fundamentals for crypto by definition. There are no fundamentals. Okay, there are no earnings, no dividends, no interest paid. The value of crypto is not zero. There is a value in it as a means of exchange, but it depends a lot on government support. So I think the key thing that the crypto bulls, the people who are really keen on crypto, that they might miss is they say, well, crypto is better than fiat currency, normal money that we think of. It's better because it's so flexible and it's easily transferable and it can't be taxed and it can't be managed, can't be managed by the governments. They forget that that's the point of fiat currency. The fact that fiat currency is under control of authorities is a feature, not a bug. Okay, so it's going to be a rare government that's going to be really in favor of a currency that they don't control. Maybe the Trump administration is that rare government. I'm not sure. It's possible. He's certainly much more favorable towards crypto than you would expect of most governments. Okay, so that's probably one of the tailwinds for crypto at the moment. The other crypto that I think has potential is the Chinese one, which is a government-sponsored cryptocurrency. That makes perfect sense. They would want that so they can actually get more control over where spending is going in their economy. Okay, but the kind of crypto that basically that runs in a kind of black economy that avoids government control, I don't see why any government would want to support that. Why would they make that easier? If anything, they're more likely to put barriers in the way, make it harder to use that sort of currency. So that's the headwind for crypto. And within those bounds, then you've just got a lot of sentiment. How are investors feeling? Is there a lot of hot money running through the markets? You'll see at the same time, you'll see crypto running hard. You'll see big tech stocks running up because there's hot money chasing these opportunities. And that's just euphoric sentiment pushing those up. Okay. Doesn't mean it won't continue to go up for some time, but I just can't say crypto is a good investment based on fundamentals because there aren't any. Okay, let me just go. I think I'll just go quickly through the changes to the portfolio. Just a few of the things we've been doing lately. Now, this is a list of the holdings in our number 3 balanced portfolio. I told you we bought some resources. This is Aussie resources that we bought most recently. So that's a recent change and it's done very well for us, especially since you might have seen the announcement that China's planning to build a massive. Those sort of big infrastructure projects use a lot of steel. That's good news for our iron ore miners. Okay, so that's been a positive. Over here, we've got another recent addition, which is a US private credit fund. Okay, I won't go too deep into the weeds explaining that one, but basically it's a collection of 25 portfolios of loans to medium-sized companies in the US, the kind of companies who can't issue their own bonds. So they're not big enough to issue their own bonds. So they go to a private lending group and they borrow from them. They pay a higher interest rate for that. And so we're talking about yield earlier and income. This product has a 10% distribution yield because all of those borrowers, they can't easily get their funding from a bank. They can't issue their own bonds. So they're kind of in a difficult place. They have to pay a higher interest rate to these private lenders. Okay, and that flows through to investors like us. So a pretty attractive distribution yield, pretty attractive 10% income we can get from there in the US. Europe has done really well recently for us, so we've been trimming it. So Europe has been a very large position in our portfolio. I told you that, say, your standard industry super fund is very much focused on a benchmark index. So if you think of the global share markets and how they're broken down, global share markets are about 70% the USA. So a standard industry super fund will have about 70% of their global shares in the USA. Okay, maybe 10% in Europe. We have a much higher allocation to Europe because we thought it was better value, and a much higher allocation to Japan because it was better value. And those have both done really well for us. So lately we've been trimming those, taking profits. So Europe and then Japan, we've been trimming those. Did you remember that very first chart I showed you with all the lines of the global share markets? Japan just went straight up. That was the point we said, okay, time to take some profits. We're happy with these prices now. We can sell. We've held, a large allocation to Japan for a long time when it was really good value, not so great value anymore. And just going back, this is one of the other things we've been buying, US energy. So in all the talk about Magnificent Seven tech stocks doing really well and tariff deals and a lot of the other noise, you might not hear much about the energy sector because oil prices have not been, they've been in a bit of a lull recently. There's a few issues going on with OPEC, which I won't go into, but suffice to say, this sector looks like good value. So it's the sectors that people aren't talking about right now that are the ones we want to buy for the future. Okay, if it's something really exciting or in the news at the moment, like Europe just done a trade deal, Japan just done a trade deal, and they're riding high on that news, we're more likely to be trimming those. Okay, so US energy looks like it's got a lot of potential for the future. Yes.
With the onset of electric vehicles, has that made enough of an in-depth into petrol and oil prices yet, or is it still?
Look, there's going to be an ongoing drag.
Yeah.
And I think that's already priced. A lot of that has already been priced in. So it does make a difference, but it's a slow transition into EVs. Okay, so that's taken into account. So when we look at these sort of sectors and say, okay, this looks attractive, we really kick the tires. So we say, okay, well, what about the worst case scenario? What if everything goes wrong here? What's a fair valuation here? Okay. So we take that sort of thing into account. But also the oil companies themselves are thinking about this. So what they've actually done, one of the reasons we like the energy sector is that they've cut back on production and exploration. Okay, so they've been just saving their money, paying it out as higher dividends. So there's some extra yield there, spending less on new exploration because they don't want to grow supply. Well, if you don't have growing supply, then that means pricing is probably going to get stronger. Okay, yep. So yeah, the fundamentals look more attractive there.
Can I just add a quick question?
Sure.
You obviously have a strong emphasis on value shares.
Correct.
But when they're getting higher in their share price, you're still paying.
Yes.
When are you doing like internal benchmarking? So like, if you're holding that share for a longer period of time, you'll have your dips in high.
Mm-hmm.
But then if you, sell off and then buy something different, how does that benchmark against holding something that has a dip and having recovers?
Well, the benchmark is those expected returns.
Yeah.
That is actually a better benchmark because the alternatives are actually, it can be really hard to compare otherwise. Should we expect ExxonMobil to trade at the same price to earnings ratio as Apple? No, definitely not. One justifies a much higher price. So it's really hard to say, well, this ExxonMobil is cheap, but Apple's expensive. It's very hard to measure. But if you have those expected returns, then that is a better basis for comparison. So that is how we compare. On that tipping points chart, we can say, okay, here's where we see the relative value. And it does change over time, to be clear. So it's a bit dangerous when I show you a share price chart and I say, look, we bought here when it was low and we sold here when it was high.
Yep.
That is a bit of an oversimplification. Of course, we're taking into account, well, what's the outlook for earnings? Maybe the high price was actually justified because earnings look a lot better now. maybe the low price was justified at the time because things looked really dismal. Okay, so it's a little bit more complex in terms of the pricing. It's not just about the dollar share price, or about, say, price relative to earnings, price relative to dividends, future growth. Yeah. So that's the sort of comparison we're trying to do. And we've just added some global property trusts as well. So that's just another area where we think there's some good potential, and we're hedging those are currency hedged. So basically, there's a little bit of concern about the US dollar, because in the US, they're borrowing a lot of money, and investors in the government bonds are getting a bit more wary and starting to pull back. So that's a drag on the US currency. And also tariffs in general are making people a bit wary of the US as well. So you've seen the US dollar fall. So we prefer to be currency hedged generally. That protects us against further falls in the US dollar. Okay. So the new investments we're making, land here and property up there, are currency hedged. Okay, these are a few things we're thinking about for the future. Basically, still thinking about the tariff potential, because as I said, it's good news if you whittle these tariffs down from a threat of 25, 30% to 15%. Still, it's a 15% tax on trade. It's not good news. So still thinking about how that is going to affect economic growth. Thinking about currency hedging, because currency moves have been really significant in recent years. So the euro has rallied a lot. So our exposure to the euro, because we own a European listed Europe ETF, it's done well, not just because the share market's gone up, but also because the euro currency has gone up against the Australian dollar. So we have to think about currency exposures as well. And currency hedging, especially against the US dollar, is something we want to keep in mind and keep doing more of. China is still an open question. We don't know what will happen with the tariffs. We don't know. So those negotiations are still going on. And also if the Chinese government is going to do more stimulus for their economy. And then we're quite underweight the US. We've generally found the US share market to be quite overpriced. It's particularly those Magnificent Seven stocks. So we're looking for opportunities, other things we can buy. So US small caps look attractive. US equal weight exposures, where we can hold more of those sort of stocks that are not the Magnificent Seven. There's a few US energy. So there's a few other things we're looking at there. Okay. How are we going for time?
Good. How are you guys all traveling?
Yeah.
Everyone's still awake?
Everyone's fine. Okay. Yeah. Okay. The MBA service. Just very quickly, this is how we. This is why this MBA product is really good for you. Okay. It allows us to customize a portfolio to what you need. The benefit of the MBA is that if you have other investments, or if you have specific preferences with how you invest, we can adjust the standard portfolio that I manage to work around what you've already got. So if you've got a lot of property investments on your own, then the portfolio I manage has property in it, but we can take that out and manage everything else around it, hold more shares or bonds around your property investments, for example. If you've got, say you work for a company, you've got employee shares in that company, and they're an Australian listed, say we've got one client who works for a mining company, so they've got a whole lot of BHP shares. They don't want to double up and own a whole lot of extra Aussie shares on top of that. So we can trim that exposure for their particular client account and work everything else around it so they get a more diversified, balanced portfolio. We can also manage the trading on a case-by-case basis. So you might have a case where your accountant says, okay, this has been a very big income year. We don't want to have any capital gains realized in this particular year now. So if I'm doing a sale in our standard portfolios, our implementation team will be in touch with Sebastian and say, okay, we're planning to sell Japanese equities now. He has the ability to be able to say, no, not for this client, don't do that, because they don't want any more capital gains realized this year. We want you to hold off on that client. Don't sell anymore until the next financial year. So that kind of individual customization can work really well. It can make the portfolio much more tax effective. We can also manage cash flow. So this comes back to the question about managing income or having cash ready when you need it. Cash, if we have a sense working with Sebastian and his team, if we know what a client account will need, if you need regular income every month, or if say you've got a client who wants to, they're planning to help their kids buy a house. They know in 6 to 12 months' time, they'll need a big chunk of cash taken out of their account. You don't really want to wait until the last minute to sell, because what if we have a market crash just at that point? What if you don't want to be selling everything at the bottom of that point? So if we know that there's a large amount being drawn out of the account in that rough time frame, we can build up the cash over time. So gradually selling so that when we get to that point, wherever the markets are, there'll be enough cash to pull out without having to lock in a really low price. And then this brings us back to how we work with Wealth Depot, because we have to collaborate with them. There's sort of a co-piloting that happens over your portfolios. We don't know your individual specific account needs. Well, I'm managing a standard portfolio, and my implementation team sort of help me work with Sebastian and then tailor everything to whatever you need, okay, in terms of cash flow, in terms of tax impact, and the exposure you want. Okay, so that sort of co-piloting is really important and valuable. I think it adds a lot of value to you because you get a customized tailored service. All right. I'm going to stop there. I'd be happy to take any questions if there's anything else that you'd like me to talk to. But otherwise, anything else? Have I covered everything?
How different from the context share portfolio?
Are they managed share portfolios? Are they managed by
Like,
a portfolio manager like me? Is there someone
yeah,
buying the shares? I can't speak to that specific product,
Yeah.
but my best guess would be they wouldn't be an individually tailored account. So they'd be a cookie cutter model. So it's a one size fits all kind of treatment. Okay, so everyone holds the same shares, regardless of their tax needs, regardless of their cash flow needs. Everyone buys at the same time, everyone sells at the same time. So you lack that customization or tailoring. That's probably most likely. Yeah. Again, I don't know the specific case you're talking to. There's lots of managed investment products out there. So, yeah, the customization tailoring are this real special advantages of the MBA structure.
I remember reading an article about really big managed funds.
Yeah.
And the ability of them getting so big that every time they do a trade, it actually stuffs the market up, right?
Yeah.
So I've always, this is what I've spoken to Sebastian a lot too about this, is that people who are not the big players and not the small players, the right size to be able to get in and out of the market without actually having people look sideways and affecting the price for the detriment, because obviously you can't just sell all your positions all in 1 minute, right?
Sure.
So,
Yeah.
So that's another sort of advantage of having something very tailored rather than what you said, cookie cutter approach.
Correct. Yes.
That's
Look, it helps to be nimble.
Yeah.
So I say IPL is at a good size.
Yeah.
Where we're not so big that we're this lumbering giant.
Yeah.
And we're not so small that we get pushed around, or we don't have the resources to do what we want. So we're in that sweet spot, I'd say.
Yeah, okay.
That's special. I know this might be a bit, I think Sebastian probably explained it once before, but there's a friend of mine who got involved with Storm.
Yes.
And they lost a lot from investing into Storm. So what's the difference between that and you guys?
The difference, I'd say the key difference, I'm sorry for your friend, and there are other cases and other examples of these dodgy companies that take people's money and then it disappears. In our case, the investments, this is both IPL itself as an investment manager and also the building blocks we use, the providers, iShares, VanEck, Beta Shares, and so on. The investments are ring-fenced. Okay, so we are those, the money is actually, these accounts are separate to our business. Okay, we are like a steward of those accounts, but everything's held in your name in this case. And so you can see what's actually in your account, right? You can see which shares, which ETFs and so on, what they're priced at. Those prices are set externally. The problem you've had with Storm and some of these other blow-ups is it's an incestuous internal kind of operation where the money is actually intertwined with the business itself. Okay, they take investors' money and then they're investing it into their own operations, maybe in property or in other investments, which are all sort of tangled up. And there's nothing that's being externally verified or externally priced. So that is actually extremely different to what we do. It's, very, very far removed.
Yeah.
Okay.
To
Please.
the storm situation, they were borrowing,
Mm.
they were giving their clients to borrow more money to invest. And then they were investing in managed funds that had also borrowed to invest. So they were double gearing, it's what we call it in the industry, for their clients. And they were charging a lot of money. So that was another measure of just, as a financial advisor what they were doing. And then when we had the global financial crisis and money dried up, share markets plummeted, then the value of the shares, which was the asset compared to the loan amount, that ratio changed because the share price dropped. And so then the banks, so the people, the institutions that were lending money went back to the investors and said, you need to top up this account because now, the equity in what we're holding.
It's a margin call.
It was a margin call, exactly. And so a lot of them went out. Everything, because then they were having to sell out when the margin lenders were selling them out because they wanted to top up that additional cash. And it was at the bottom of the market. So they couldn't afford it. So it was a level of gearing, and we're not doing that in implemented portfolios. That's something that some advisors still do, typically not to the same degree as Storm did back then.
Thanks, Nicole. That's all. Yeah, I'll have it.
Obviously, Nick and Nicole, thank you very much. I think Nick, done a great job. It's a lot of complex and lot of stuff to get through, and by the looks of the faces, they probably asked them still a lot of questions and a lot of things I'm looking forward to field and understanding with you guys and work through. But also, thank you again, Nick.